Professor, here's my question right off the get-go. 3.5%, our first look at third quarter GDP, wasn't too bad, but there were certain aspects, whether it was inventories or earnings, where the horsepower wasn't quite there. Why don't you tell me your impression?
Okay, I would say the consumers came out to play after the tax cuts, and that's very clear in the consumption number. Inventories were built up, and that's getting ready for the Christmas season. And the government was spending money both on the defense and the state and local, so that was good because they have the money. The only problem was that the businesses did not come out to play. They held back on the investment. If you look at the structures, both the interest rate effect was there on the commercial building and the industrial buildings. And of course, oil was a lot of investment, so it took a breather. But even then, investment was weak.
So that contributed, in your opinion, to this notion that one of the big missing ingredients for many years now has been productivity. And all those light areas you described certainly aren't boosting productivity with respect to this number. Would that be correct?
Yes, because one ingredient, key ingredient to productivity is people work with the machines, which is investment. And if you don't do it, you're not going to get the productivity down the road. Skill of the labor is important too, but you still have to invest.
You know, Professor, we had Cleveland Fed President Mester on earlier today, and she made a comment that they believe 3.5% is wonderful, but that the real sustained growth rate in this country is closer to 2%. Do you agree with that?
I would say that the Fed thinking is 2% is the potential. I would say since the last election, and the way I've seen the investment go and with the tax cuts, I'm willing to go up to like 2.5% on a sustained basis. But I don't see investment there to make me go to 3 or higher than what people were thinking. And that is where the disconnect is between what people are thinking and how the reality is coming out.
You know, pursuant to that exact notion, we also had Budget Director Mulvaney on today, and he said that the tax cuts really weren't tax cuts. There was much reform, and some of the reform should continue to help in those weak areas you just described to raise the sustained growth rate. But even the difference between 2 and 2.5% is a lot of money within the economy, is it not?
Yes, when you take difference between 2.5, and you project it over 4 or 5 years, it becomes a big difference. Now, tax reforms were there, and the corporations were already investing quite a bit even before the tax reform. The problem now is that the business cycle is mature, so the low-hanging fruit is gone. And if you want to do more investment, you are getting into a little bit more risky areas. And that's where with the talk on the trade and tariffs, it's not helping.
I got you, Professor. That's most likely what the stock market's been grappling with most of this week.